Let's move on. Our next guest downgraded 6 homebuilder stocks earlier this week. Evercore ISI Stephen Kim joins us now. He is the firm's head of housing research. Stephen, great to have you with us.
Having me.
So is it more than just a rates problem for the homebuilders at this point?
Oh, yes. So a big part of our downgrade on Tuesday morning was our understanding that the administration was going to aggressively pursue supply side solutions to affordability, which is really the worst possible thing that the builders could hear. And I think that FHFA Director Pulte has been very clear and increasingly clear in his tweets and interviews about what it is that he's looking for. The administration seems to believe that we have a national housing deficit because we didn't build enough homes. The deficit is why home prices are so high and that housing's become unaffordable. Higher home prices are also contributing to inflation because the shelter component of CPI is high. And then they look at the builders and they say these builders are deliberately building fewer homes than they could. They're posting strong profitability and cash flow and buying shares back. And they say, well, look, if the builders could produce more homes at lower prices, home buyer affordability gets better, inflation gets better, employment will improve. And they believe that new home prices can decline, even without dragging down existing home prices, which, by the way, has kind of been happening as well. So there's a lot of truth in what they say. At the same time, it misses something critically important, which I think the builders are really hoping that they recognize, which is that we have a demand problem right now. I think you all have been talking about that. We don't actually have a supply problem right now. If they could have gotten builders to build a lot more maybe 3 or 4 years ago, that would have been different. But today you're now slamming the gate shut when the horse has already left the barn. We don't have enough demand. And so I think that having the administration focus on supply side as opposed to mortgage spreads, I think that's a problem. And I think it's unfortunate for the builders.
Stephen, yeah, it's certainly a problem for margins. It sounds to me, and to think 1 or 2 steps down the road at a time when we have heard the White House aggressively, target certain parts of certain industries, if we can look past this, what I was reading between the lines on your notes is that you actually think that the multiple for the sector should go higher based upon the prudence and the approach they've had towards capital allocation, especially after a difficult period of demand. Is that fair?
100%. So we've actually had a multi-year call here where we say that, I should say over the next few years, we believe the builders deserve and will get a revaluation to higher multiples than they have historically received. And the basis for that is that if you look at how much the builders have improved their operations, if you look at how they have become more asset light, they have more competitive advantages relative to their smaller peers. And so we look at all of what they've done and they've delevered significantly, that these are companies that, frankly, if you compare them across almost any metric that matters relative to their S&P peers, I mean, they outperform them, but they trade at a fraction of what the other peers trade. So we think that that's going to change. And we'd say, by the way, there's a builder out there in the wild called NVR that's already done this, and the other builders are sort of following the footsteps. So we actually think that the builders are looking really good from a multi-year perspective, but unfortunately, you cannot disregard what the government and the administration is seeking to do here. And in the near term, it's going to be, we think, a depressant on the builder stocks.
So along those lines, you downgraded, I think, DHI, Pulte Homes, Toll Brothers, if I'm not mistaken, to inline from outperform. But the price targets you have, although cut, are still higher than these stocks are trading. My question is, what's the next leg lower in terms of price on your horizon if, in fact, you have to go from in line to underperform or whatever the next one down is?
I think it's fair to say that the basis for our downgrade, and we moved everything we cover from that was a buy to a neutral. We have no buys in the space, and we basically earlier this year had all the builders buy. We were probably the biggest bull on the space. The basis for our downgrade was this. The risks that were becoming very clear, these exogenous risks coming from the administration. We don't fully know how those are going to play out. We're just getting a taste of it now. And so therefore, depending on how severe these changes that they're seeking to make with the builders actually are, that could change, the outlook for the earnings and the price targets as well. But we took a first swag at it based on limited information. What we knew is that it was going to be big, it was going to be important, and then investors were not ready for it. That we knew, and so we acted on that. Long term, I still like the group, like I said, but certainly we'll be watching this situation as we go forward, and we'll adjust our price targets as we need to.